Let me paint you two pictures. Picture 1. The US economy in 2026 is actually fine. Inflation is cooling. The Fed keeps cutting rates. AI productivity explodes corporate earnings. The stock market grinds higher. Your 401k looks great by December. And everyone who predicted a recession looks like an idiot again. Picture 2. 2026 is the year it all finally breaks. The debt crisis nobody wanted to talk about becomes impossible to ignore. The AI bubble pops. The job market quietly falls apart. And the market drops 40% while financial media is still arguing about whether we are in a soft landing. Here is the uncomfortable truth. Both of these pictures are completely possible, at the same time, right now. And what makes 2026 genuinely different from any other year is that the gap between the bull case and the bear case has never been wider. The optimists and the pessimists are not just disagreeing on magnitude, they are living in completely different financial realities. So today we are going to do something traditional financial media never does. We are going to give both sides a completely fair hearing, the bull case and the bear case, using only real data and real facts. And then at the end, I am going to tell you about the third scenario, the one nobody is positioned for, the one that might actually be the most dangerous of all. Let us get into it. The bear case. Let us start with the bear case. Because if you only watch mainstream financial media, you would think everything is basically fine, and anyone who disagrees is a perma-bear who has been wrong for 5 years. So let us look at the actual numbers. Bear point, the debt bomb is ticking. The United States national debt just crossed $36 trillion, not billion, trillion, with a T36 of them. To put that in human terms, if you spent $1 every single second without stopping, it would take you over 1,000,000 years to spend $36 trillion. And right now, the United States government is adding roughly $1 trillion to that debt every 100 days. Not every year, every 100 days. Here is why this matters in 2026 specifically. The US Treasury has to refinance, meaning roll over and replace approximately $9 trillion of existing debt this year alone. That is $9 trillion of old bonds coming due that need to be replaced with new bonds at current interest rates. Rates that are significantly higher than when that old debt was originally issued, which means the interest payments on the debt are exploding. The US government now spends more on interest payments on its debt than it spends on the entire defense budget. More than it spends on Medicare, more than it spends on education, just paying the interest, not reducing the debt, just keeping up with the interest. And as Ray Dalio, founder of the world's largest hedge fund, has repeatedly warned, when the supply of new government bonds consistently outpaces demand for them, yields have to rise to attract buyers. And rising long-term yields affect everything. Mortgage rates, corporate borrowing costs, stock valuations, everything. The debt is not a future problem. The refinancing is happening right now. Bear point 2, the AI bubble has us all. The hallmarks let us talk about AI, because right now AI is doing for the stock market what dot-com companies did in 1999. It is being used to justify valuations that have completely disconnected from financial reality. Nvidia trades at around 35 times earnings. Palantir sits at over 400 times earnings. These are not small speculative startups. These are companies that are already enormous, being priced as if they will dominate the entire global economy for the next 50 years, without a single competitor ever showing up. And here is the data point that should concern every investor right now. According to multiple enterprise surveys, approximately 95% of companies experimenting with generative AI are currently generating zero measurable return on their AI investment. Zero. The hype is real. The productivity gains, at scale, across the economy, are not showing up in the data yet. And the Magnificent Seven, Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia, now make up over 33% of the entire S&P 500. 7 companies, carrying a third of the entire index. History has shown us this movie before. In 1972, it was the Nifty 50. Blue-chip companies so dominant that investors called them one-decision stocks. You only ever had to decide to buy, never to sell. Coca-Cola traded at 46 times earnings, McDonald's at 86 times, Polaroid at 90 times. Then the market dropped 50% between 1973 and 1974. Polaroid fell 90%, and the market took 8 years to recover. The Magnificent Seven are the Nifty 50 of our generation. Different names, same dangerous concentration, same dangerous valuations. Bear point 3. The consumer is running on fumes. American consumers have been the backbone of the US economy for decades. Consumer spending accounts for roughly 70% of US GDP. But right now, the American consumer is quietly running on fumes. Total US credit card debt crossed $1.17 trillion for the first time in history. Credit card delinquency rates are freezing at their fastest pace since 2010. The personal savings rate has collapsed from over 8% during the pandemic to under 4% today. Buy now, pay later debt is exploding among 18 to 34-year-olds. and student loan payments resumed after a multi-year pause, pulling billions out of discretionary spending every month. The consumer has been keeping the economy alive by spending money they do not have, and that strategy has a very clear expiration. The bull case. All right, that was the bear case. Now let us be completely fair, because the bears have been predicting a recession for 3 years, and 3 years later the economy is still standing. The stock market is near all-time highs. Unemployment is still historically low, and anyone who went to cash waiting for the crash missed one of the great bull runs in market history. So what do the bulls actually see that the bears keep missing? Bull point 1. The Fed still has the wheel. The Federal Reserve ended 2025 with 3 consecutive rate cuts, and the market is currently pricing in at least one more cut in 2026. Here is why that matters more than most people realize. Every single time the Fed has moved from a hiking cycle to a cutting cycle in modern history, risk assets, stocks, real estate, corporate bonds have responded positively within 12 months. Every single time. Lower rates mean cheaper borrowing for companies. Cheaper borrowing means more investment, more hiring, more expansion. It also means the discount rate used to value future earnings drops, which mechanically pushes stock valuations higher even before a single dollar of new earnings is generated. And here is the part the bears always underestimate. The Fed still has significant room to cut further if things get bad. Unlike 2008 when rates were already near zero, the Fed currently has real ammunition left. If the economy starts deteriorating rapidly, the Fed can cut aggressively and inject enormous amounts of stimulus into the system. The Fed is the biggest safety net in financial history, and it is still fully loaded. Bull point 2. The government will keep spending. While everyone is arguing about whether the Fed will cut by 25 or 50 basis points, the US government is doing something far more impactful: spending aggressively, and it shows no signs of stopping. The CHIPS Act, the Inflation Reduction Act, infrastructure spending, defense spending at generational highs. These are not abstract policy debates. These are trillions of dollars being injected directly into the economy, into factories, into construction projects, into manufacturing, into technology development. Government spending of this magnitude is essentially a direct subsidy to corporate revenues. It supports employment. It supports consumer income. And unlike monetary policy, which works through the financial system indirectly, fiscal spending hits the real economy immediately and directly. And here is the political reality. No politician in American history has won an election by campaigning on spending cuts and austerity. The spending is not stopping, which means the fiscal support to the economy is not stopping either. Bull point 3. AI productivity is real and coming. Yes, the valuations are stretched, but let us not confuse stretched valuations with a technology that does not work. AI is genuinely transforming productivity in specific sectors right now. Legal research, medical imaging, software development, customer service, financial analysis, code generation. The productivity gains in these specific applications are real and measurable. And historically, the biggest technology productivity waves, the railroad, electricity, the internet, always had a period of massive overvaluation followed not by permanent collapse, but by a shakeout that eliminated the weak players, while the strong ones went on to generate extraordinary long-term value. The dot-com crash wiped out Pets.com. It did not wipe out Amazon. The AI correction, whenever it comes, will wipe out Palantir at 400 times earnings. It probably will not wipe out Nvidia entirely. The question is not whether AI is real. The question is whether current prices already reflect the next 30 years of AI value. And that is where the bull and bear genuinely disagree. The uncomfortable middle, all right. Now we get to the part nobody is talking about, because I have given you the bull case and I have given you the bear case. And if you are like most people right now, you are somewhere in the middle, nodding at the bull points and then nodding at the bear points and ending up more confused than when you started. And that confusion is actually the correct response. Because the most likely outcome for 2026 is not a clean bull market, and it is not a clean crash either. It is something much harder to navigate than either of those. It is a long, grinding, choppy, frustrating sideways market. And here is why that is actually the most dangerous outcome of the three. In a bull market, almost every decision you make looks smart. You buy, the market goes up, you feel like a genius. In a bear market, the strategy is clear even if it is painful. You hold, you wait, you buy more at the bottom if you have the stomach for it. But in a choppy sideways market, the kind where the S&P rallies 8% in 1 month and then gives it all back the next, where every dip looks like the start of a crash and every rally looks like the start of a new bull run, most investors get destroyed. Not because the market collapses, but because they keep making decisions. They sell after a drop because it feels like the beginning of something worse. Then the market recovers, and they buy back in near the top. Then it drops again, they sell again. And slowly, painfully, they underperform doing nothing would have achieved. And the data supports this. Studies consistently show that average retail investors underperform the index by 3 to 4% annually. Not because the market is doing badly, but because choppy, uncertain markets trigger emotional decisions that destroy returns. Here is the specific setup I see for 2026 that makes this choppy middle scenario extremely plausible. The debt refinancing pressure keeps long-term yields elevated even as the Fed cuts short-term rates. This creates a steepening yield curve where short rates fall but long rates stay stubbornly high, which means mortgage rates stay uncomfortably high. Housing stays frozen. Corporate borrowing costs stay elevated for long-term projects. Meanwhile, the AI trade keeps the stock market propped up, but only at the index level. Underneath the surface, the average stock is going nowhere, while 7 technology companies absorb all the passive money flowing into index funds. And every 2 weeks, a new headline flips the narrative completely. One week, the jobs report is strong and everyone is bullish. The next week, a manufacturing number disappoints and everyone is bearish. And the market swings violently between both narratives without ever establishing a clean direction. That is the gray area. That is where portfolios go to quietly die, while investors convince themselves they are still in control. What to actually do now? I want to be very clear about something. I am not a financial advisor, and nothing in this video is financial advice. What I am about to share is simply how I think about navigating genuine uncertainty. Because the honest answer to what to do in 2026 is not a hot stock tip. It is not a secret asset class nobody knows about. It is something far less exciting and far more effective. It is building a portfolio that can survive all 3 scenarios. A portfolio built for the bull case means holding your index funds and your quality growth positions. Those perform well if the market continues higher. A portfolio protected for the bear case means having some allocation to assets that do not correlate with equities. Treasury bonds at current yields, gold which has been hitting all-time highs, and simply holding some cash, which at current yields is actually paying you something for the first time in 15 years. And a portfolio built for the choppy middle means the most important thing of all, having the discipline to do nothing when every headline is screaming at you to do something. Because here is the most counterintuitive truth in investing. In uncertain markets, the investor who trades least usually wins most, not because they are smarter, but because they make fewer mistakes. The market does not reward activity, it rewards patience. So here is where we land on 2026. The bull case is real, the rate cuts are real, the government spending is real, and the people who have been predicting a recession for 3 years have been wrong for 3 years. The bear case is also real, the debt is real, the concentration is real, the consumer stress is real, and stretched valuations have a way of correcting at the worst possible moment. But the most likely and most dangerous scenario is the uncomfortable middle. The choppy sideways market that does not crash dramatically enough to create obvious buying opportunities, but does not rally cleanly enough to reward sitting still. The market that kills portfolios through 1,000 small emotional decisions rather than one big crash. Now I want to hear from you. Drop a comment below. Are you in the bull camp, the bear camp, or are you sitting in the uncomfortable middle wondering what on earth is going on? Because I can guarantee you one thing. Nobody actually knows what is going to happen next. And if anyone tells you they do, they are either lying, trying to sell you something, or both. And that is exactly why you need a channel that gives you both sides honestly, instead of just telling you what you want to hear. Hit subscribe and turn on notifications. Because the biggest financial risks of 2026 are not going to announce themselves on the front page of the Wall Street Journal. They never do.